I like to visualize processes and to do so with a graphical image. In this case, I'm taking a look at the entire recovery process. And when you look at the recovery process, there are a lot of different things that can happen. You can have internal error and fraud, which is just the normal duplicate payments or overpaying on an invoice, or the system control didn't catch a PO price being different from the invoice price, all things that come out. External error and fraud, where the company, the vendor, is actually billing you inappropriately, but for the same reasons. Usually it's error, sometimes it's fraud. And also, other recovery is just taking a look at what the industry is paying for things and benchmarking to that industry. Likewise, tax advantages that you might get by doing that industry benchmarking also come out of that. So we're looking in a retrospective, backwards kind of way to see if we can find old things that are still on the books, such as the simple duplicate payment or a debit that's outstanding. And prospective, such as things of maybe it is a tax advantage or it's a new price that we're going to pay. And that's more around, again, the timing of things. It's prospective and retrospective. So you have some go forward and backward relationships. And when you're looking into it, a lot of it comes down to basic fact checking, taking a look at pricing, and also from an analysis and forecasting point of view, looking forward. So in more specific, these are the profit opportunities that I've outlined to date and spent some time in each category really thinking about what happens in each one. And I find that the first type of recovery audit you should do is an accounts payable audit, because it covers the gamut of your spend and is more at a high level, but yet can find a lot of trends and also detect potential contract audits that you'll want to do. And a lot of these audits then are contract audits, audit fee benchmarking, advertising agency, freight, lease, etc. Then there's fraud. You can detect cash. You can hopefully prevent or deter people from committing fraud at the company if you have very strong controls, and that again saves you money. The tax breaks are also there, and again, most of this is, for the most part, a contract audit. So let's go into more detail now and talk about each one. So first off, there's the accounts payable audit. The accounts payable audit generally is there to find duplicate payments, any sort of overpayments that are more simple, at more of the invoice level or the payment stream level. Statement errors, where you're sending out statements to vendors to determine if they have debits that are sitting on their books waiting to be taken back by your company. And I find also to take a look at how payment terms are made to those vendors. And from these audits, either the AP firm does this or another firm does this, you can start to do these contract audits. Contract audits, starting off with the audit fee benchmarking, I think they go back to, I'm just going to go back one slide here, and they go back to the different types of problem or recovery that take place. You're really, when you're doing a contract audit, you're going to spend a lot more time looking on one side of the book, the client side, for internal error and fraud, than on the other side of the book, external error and fraud being the vendor themselves. You're also going to do some benchmarking, take a look at industry statistics, take a look at any sort of tax advantages that were lost, and then look at the contract in detail and really understand what is the relationship per this contract. Some contracts are written well, some are not, so that's something to consider looking into as well, changing. But with that said, those contracts normally have with them an appendix that keeps changing. That's the price sheet, and that price sheet should also be reviewed. And again, if you do a 2-3 year audit of a vendor, you might have many different price sheets depending, but some of them are usually annual or every quarter, let's say. So it's not that hard to do once the prices are loaded. But it is something where at that point you are then looking at every purchase order, every sales order, from their side and your side, matching things up and trying to understand how that relates to the contract. So getting back to some of the contract audits, one of the first ones that you could do is audit fee benchmarking. where you're taking a look at audit fees that you're paying. And there is a company out there that has been tracking statistics around audit fees, has done so on 20,000 public companies and 1,500 accounting firms, but has done so by mostly taking a look at the 10K, 10Q, and all of the other public filing information that's out there on fees that are now reported, as well as auditors and which offices of that auditor and personnel at each company, and et cetera, et cetera. And it's very detailed. They also have brought in other data as well to kind of support that, and it really makes for an excellent benchmarking tool for taking a look at audit fees. So just heading back to the slide presentation here. So, there is some talk about mandatory auditor rotation these days, and maybe that would help in when you do your next rotation that you take a look at something like this, because if anything, it's just very good information that you can use. And as you go through these contract audits, that's what I've learned. Each auditor tends to be quite good in their industry. Let's talk about the advertising agency one. Most of the recovery firms out there have people that have been very senior at the vendor organization. So if it's freight, they may have been very good at or been very high up in the UPS or FedEx arena. If it's an advertising agency, it might be a past CFO of an advertising agency that is now handling the recovery audits. And you get a much different perspective when you have people that have been on the inside or on the other side and can understand where the skeletons are hidden, what type of games are played, etc. So what I find is with the recovery audits, an advertising agency audit is going in, instead of just doing a benchmarking now like audit fees, you're actually going in and doing an audit of that agency, looking for every type of trend or recovery that you can find across the internal error, external error, benchmarking, all of those categories that we talked about. So just taking a case study approach now and looking at a couple of case studies. This is an example where $4.5 billion a higher education organization and $3.1 million in recoveries were found. So of those 3.1 million, that represented about 0.07%, and that is very common that you'll find of the total spend, the recovery will be about 0.1%, and if you round up the 0.07, it's the 0.1, and the audit is ongoing, which means that they probably will find the other 1.4 million that's sitting out there to get them up to that full 0.1%. And now with that said, $29 million related to just two vendors, and within that there was $500,000 of recovery. In that, why did that happen? Some of it was a double billing practice where they started kind of changing the second invoice, and maybe it was a mistake, maybe it wasn't. And then the other one is where there's a return process that might have been a bit out of whack. And this unearthed it, and it's more at an invoice level that things like this are found, where you're starting to see payments and credits, and it's more at a high level, not at the pricing level, but you still can find quite a bit of money. And you can also identify some of these vendors that you may have problem with, like these two, where you may want to go do more of a contract audit or just do an audit of that entire vendor spend at that high level like we talked about. Another thing that was talked about was escheatment, and savings that can come through escheatment is, in their case, they had outstanding checks that they were able to move internally by basically mailing payees and doing internal research to determine whether or not those outstanding checks were truly owed. And what they found was, in most of these cases, it wasn't owed by checking in with the payee or doing internal research. I think when you look at an agency in this case, and this was meant for an advertising agency, but it could relate to every contract audit. You could change agency for the word vendor and it would work fine. Did you overpay the vendor? Due to an error in paying that vendor's invoice? More on your end. You paid a fax and then paid a regular copy. Did you overpay the vendor in this case due to an error by the vendor in paying the vendor's invoices. So did the vendor charge you for things that might be on their books, such as, in this case, an advertising agency will actually charge you for media that they may have bought on your behalf. However, if they mess that up a bit, then you're going to be double paying that as well. Are there charges that just don't reconcile to the contract? It could be as part of an agency fee in this case, or it could just be a charge that doesn't count. I mean, anyone who looks at their telephone bill can usually find 2 to 3 things that just shouldn't be there. When you start to look at that vendor books, and this is what's more interesting, when you get the vendor's books and do this contract audit, you start to find a lot of cleansing adjustments and other unsupported charges in there, and that can be also useful in your research. There may be float costs such as discounts lost, etc., in the process between what that vendor is paying on your behalf and what you're paying. Again, it's very difficult to know any of this stuff without getting their side of the books. So are there any monies that are being held on your behalf on the books? And then last but not least, is there a conflict of interest between a supplier, the actual vendor themselves, and your organization? Now that we have seen the more general questions, you can look at these results per AARM, the advertising agency that put this together, and when you see all of these changes, these recoveries, they actually relate exactly back to those questions. Job credits not returned, time value of interest on clients' funds, duplicate payments, etc., are all part of those questions and come out of just getting clarity on that relationship, where normally you don't have the clarity because you don't have the other side of the books, the vendor side. Other vendor audits that exist, and we'll spend a little bit more time on the health benefit one because it's so critical, are taking a look at your document fleet, which is actually looking at all of your document imaging assets such as fax machines, copy machines, and normally it's just copy machines. They can cost up to $30,000 to $40,000 a year to run between toner, paper, the lease cost. So what the document fleet experts will do is come in and put wireless devices on every machine that you care about, that's worth counting, and then they will track usage. So you've probably noticed there used to be a copy machine right outside your desk, and you would run over there and it'd be very convenient, and now it's down the hall to the right after the coffee. And the reason for that was normally they did a study and realized this machine just isn't getting the usage that it should. But also the document fleet experts are quite good at what the maintenance contract should say, how you should be charged, what should the toner cost, etc. A freight audit, a lot of people think that freight audits relate to very heavy or medium style freight costs, but they could just be your FedEx and UPS charges, and many companies have no thought of having freight, but when you actually look at their spend, they do have quite a bit of this postage cost that could also be looked at as well. So if freight is something that every company should take a quick look at, and also make sure that all of these questions are answered. I mean, are we getting the right pricing? Are we charging for being charged for things that we shouldn't be charged for, etc.? From a health benefit point of view, we're going to spend a little bit more time on this one, but I find that at most organizations, health benefits is number 2 or number 3 largest expense that you have, and it's so big that usually Treasury handles it, and it's done by wire directly to the third-party administrator, or sometimes it can be to an insurance carrier. But insurance carriers, I find for most medium-sized to large companies, they tend to be self-insured, so they actually are paying every invoice that comes in from the provider, but it is then filtered through this third-party administrator that applies discounts to it, because there might be a group rate on, say, doing a physical for your employees, or it may not, and they'll also make payment on, say, surgery or what have you. But in doing this, they're paying on your behalf, and in many ways, it's not their money. I mean, they're processing your money, so it may be in a situation where they don't have as much concern if some of these procedures shouldn't be processed, or if they're being processed at a wrong rate. Again, it's more your money, not theirs. So it is in your best interest to take a look at that relationship, not to say that they're doing a bad job, but just to make sure that they are doing a good job. Now, when you take a look at it, this slide is trying to show you the different types of claims or things that go on. So enrollment happens in your health plan, you have claim payments, and you have provider billings. And this is where you start to see the different types of issue. There may be claim payments where there's abuse. People are, let's say, have a bit of a drug scam where they're going around and trying to get things paid on their behalf that they shouldn't. Provider billings might be where the provider, the doctor themselves, is upcoding or unbundling services, and we'll give you an example of that. And then in enrollment, that's more where people just don't know a lot of times that their dependents aren't covered anymore, or themselves may not be covered anymore as well. So enrollment can come up quite a bit. So this is trying to give you an idea of where it happens and from what process level the waste, abuse, and fraud occurs. So if you take a look at all the enrollment type tests out there, there are a lot of tests. I mean, you could have student child, adopted children, legal guardian child, domestic partners, common law marriages, divorces, etc. All of this, it runs the gamut. So there's a lot of different tests to take a look at. And when you take a look at this slide here, these are the most common tests being done for enrollment. And what I find is that there are actual percentage points that enrollees will come off, be it 5%, 10% of the enrolled people in the plan will immediately come off the plan because you realize that they're not part of the plan rules, and hence they can't be part of the plan and have payments made on their behalf. Jumping over to the claim audit tests, this is where you may find some duplicate payments, non-contractual payments, where it maybe you have a plan with that particular third-party administrator, but the plan is not being paid on. The system itself does not kind of catch all of your plan specific, and hence will pay things incorrectly. You may want to take a look at coordination of benefits, where are we ensuring that we're going to the primary person first, or going to Medicare or what have you first before using our coverage. So again, these are all the different types of claim audit tests that you could do. Wanted to show them to you, but yet we'll kind of keep moving here in the interest of time.